President Trump has promised that lower mortgage rates are coming.
Reducing mortgage rates is a big factor. We're going to get them back down to, we think, 3%, maybe even lower than that.
But will we actually see 3% mortgage rates in 2025 or 2026? And even if we do, what would that do to the housing market? Let me break this down. If you want to go out and buy a house with a mortgage, your mortgage rate is generally not set by the president and is generally not set by the government. You'll see why I'm saying generally in just a moment. It's generally set by your bank. So now you want to get a mortgage to buy this house, and now you start shopping around like everybody else. You want to find the best mortgage rate with the best customer service, and you start looking at Chase Bank, you look at Bank of America, you look at Rocket Mortgage, and now you start comparing. And you see that one bank has a 7% mortgage rate, but their customer service isn't the best. Bank number 2 has a 7.2% mortgage rate, and their customer service is a whole lot better. And now you have to decide, where are you going to go? So banks can compete against each other by offering you better mortgage rates, they can offer you a better experience, a better customer service, or they can just be better with marketing. But every bank wants you to get your mortgage through them. So the question then becomes, why are banks offering 7% mortgage rates as opposed to 3% mortgage rates? And that's because banks also have a cost to borrow money. So when banks give you money, this is called your mortgage, and the interest rate that you pay is called your mortgage rate. But banks have to pay to get that money as well, because banks are not sitting on huge piles of cash. Banks follow a system called fractional reserve banking, which I'm not going to get into in this video, but what that means is when they go out and lend you money, they have to borrow that money from somewhere else. They're borrowing that money from another bank. So they're selling you this money at the mortgage rate, but they also have to buy that money. And the interest rate that they pay to borrow this money from another bank is called the federal funds rate. Now, this is where things can get a little bit confusing, but if you stick with me, I promise I'm going to break it down as best as I can to help you understand. This federal funds rate that banks have to pay in order to borrow money from other banks is not set by the government, it's set by the Federal Reserve Bank. Now, the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're actually not a bank. You and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not federal because they're technically not a part of the federal government. So this Federal Reserve Bank has the ability to raise or cut the federal funds rate. If you've ever heard the news that the Fed is cutting interest rates or raising interest rates, this is the interest rate that they're talking about, which can ultimately have an influence or impact on the mortgage rate that you pay, because it can influence the cost that the bank has to pay to borrow money. But you can still see that Trump is sitting here in the government, which is separate from the Federal Reserve Bank. Now, if you've been reading Market Briefs, which is my free financial newsletter, you already know this. But based off of what we know today, it doesn't look like we're going to see a big reduction in the federal funds rate in 2025, because the Federal Reserve Bank is still concerned about inflation. They're still concerned about the economy. And they say that they're not going to be influenced by what the government or what Trump says, because Trump says that the Fed should start cutting interest rates. But the Federal Reserve Bank says, yeah, we don't think we're going to be very aggressive with interest rate cuts in 2025. That's what we know today. So based off of that, it doesn't look like we're going to see a huge cut in this federal funds rate. But that's just the beginning. The second part of this question has to do with how much wiggle room banks have to actually lower your mortgage rate based off of where we are today with the federal funds rate. And that requires you to take a look at what alternative investment opportunities the bank has when they're going out and deciding where they want to go out and lend their money. By the way, if you want to stay up to date on what's happening in the financial markets when it's happening, Market Briefs is a free financial newsletter that my team publishes every day. We cover what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning, and it's completely free. So if you don't love it, you can unsubscribe at any time. If you haven't joined Market Briefs yet, I got the link for you to join down in the description below. Banks are in the business of making money. Not for you particularly, but for themselves. And the way the bank makes money is by investing their money. And the way they invest their money is by lending their money out. And you probably know that all debt is not created equal. For example, if you go to the bank and said you wanted to get a mortgage, they're going to give you one particular interest rate. If you go to the bank and say you want to buy a car, they're going to give you a different interest rate. If you go to the bank and say you want to open up a credit card, they're going to charge you a different interest rate if you carry a balance on your credit card. So what the bank does is they look at that investment opportunity. They look at the lender, they look at the loan, and then they give you an interest rate based off of that risk. And so when banks are going out and determining how much they're going to charge you on your mortgage rate, they do that same analysis. They look at how risky of a borrower you are, and they compare you to the other lending and investment opportunities there are. So they might compare you with your broke cousin Bunty with something else like the United States government. Because, well, you and I can lend money to the United States government. And lending money to the United States government has historically been known as a risk-free investment, because it has been known in every economics textbook that the United States government always pays their bills. Now, we all know that the United States government is running a historically large national debt with a historically large national deficit, but I'm going to ignore that topic for the purpose of this video. But the United States government has the ability to tax people, and they have the ability to borrow essentially infinite amounts of money from the Federal Reserve Bank, and so they're able to pay the bills. So now, when the bank is making their decision of how much money they should charge you on your mortgage rate, they're taking a look at your risk profile, but they're also taking a look at what type of return they would get if they were to lend their money to the United States government. This is called a treasury. When you lend your money to the United States government, you are buying a treasury. And so when treasury yields go up, meaning the interest rate that the government pays goes up, well, that means the bank has to charge you a higher interest rate as well, because if the government is paying out a higher yield, meaning a higher interest rate, you bet the bank's going to want a higher rate of return from you as well. And if we take a look at the 10-year treasury yield for the last 5 years, you can see that treasury yields for the last 5 years have gone up quite a bit. And now you can start to see why the mortgage market has been so difficult. On one hand, the federal funds rate is so much higher today than where we were back in 2020 and 2021. And number two, the treasury yields that the government is paying out are also so much higher, which is why now banks are charging you much higher mortgage rates. By the way, I gotta tell you, for my male followers, I drew a mustache, which in my native language Punjabi we call a much, and for my female followers, we drew a braid, which in my native language Punjabi we call a gut. Now that you understand that, let's talk about how Trump can try to bring mortgage rates down to 3%. Here's why this is so important. Let's assume you want to buy this house 0% down, just to make the numbers easy. You want to borrow $500,000 at 7%, you're going to pay $3,326 on this house. If you can get a 3% mortgage rate, now your monthly payments fall to $2,108 a month, which means you're going to save about $1,200 a month for buying the exact same house, borrowing the exact same amount of money with just a lower mortgage rate, which means you're saving about 36% a month on your monthly mortgage payment. But that's not all. Having a lower mortgage payment could also mean that maybe you can buy more home, because assuming that you can afford this $3,326 monthly payment, if you could get a 3% mortgage, that means now you can afford more than a $500,000 mortgage. You can afford more than a $600,000 mortgage. You can afford more than a $700,000 mortgage. In fact, now you can afford around a $800,000 mortgage if you can borrow it at 3% as opposed to 7%, which means now you can buy more house. Now you're probably wondering, well, could lower mortgage rates make housing prices go up even more? Let's save that topic for the end of this video. So now what can Trump do to actually bring mortgage rates down from around 7% down to 3%? 3 things. He can work to bring down the federal funds rate, he can work to bring down treasury yields, and he can try out what I like to call the X factor. So let's break this down, starting with bringing down the federal funds rate. Now, if you remember what I said just a moment ago, President Trump is part of the government. He's not a part of the Federal Reserve Bank. So he doesn't have the ability to influence the federal funds rate, because the federal funds rate is set by the Federal Reserve Bank. So can Trump directly change the federal funds rate? No. But what he can do is try to put pressure on the Federal Reserve Bank. But this is where Jerome Powell has also said, no, he's not going to do that. But this is where Trump could potentially try to bring on a new chairperson of the Federal Reserve Bank. Now, as an attorney who's not your attorney, I'm going to tell you again, this is where things can get a little bit complicated. But again, I'm going to try to keep it as simple as possible to help you understand. Generally, the president does not have the power to fire the chairperson of the Federal Reserve Bank, because they are separate entities. But there are some loopholes. Let me read you a sentence from the Federal Reserve Act. Each member of the Federal Reserve Bank shall hold office for a term of 14 years from the expiration of the term of his predecessor, unless sooner removed for cause by the president. Let me explain what that means. If you are appointed to the Federal Reserve Bank as a governor, you get to be there for 14 years. Once you're there, you have the ability then to potentially get elected as the Federal Reserve Bank chair, and then you are there for 4 years at a time. Jerome Powell is the chairperson of the Federal Reserve Bank, serving one of his 4-year terms. But notice what it also said, for cause. If there is, quote, cause, then the president could potentially remove the chairperson of the Federal Reserve Bank. So what does this mean? Trump does not have the ability to set the federal funds rate, which impacts your mortgage rate. Trump does not have the ability to tell the Federal Reserve Bank what to do. Trump does not have the ability to fire the chairperson of the Federal Reserve Bank, but if there is, quote, cause, he could potentially fire the chairperson of the Federal Reserve Bank, who is Jerome Powell, and replace it with somebody who might be a little bit more favorable to cutting interest rates. Will Trump fire Jerome Powell? Well, we don't know. But this is where you can start to see the possibilities of what is potentially possible. Again, I just want you to understand what's happening, not telling you what's going to happen. That way you understand how our economic system works, because this can impact your mortgage rates and every other piece of our economy. But I should also say this. Jerome Powell was selected as chairperson at the Federal Reserve Bank during Trump's first term as president in 2017, and then he became the chairperson in 2018, and then in 2022, President Joe Biden reappointed Jerome Powell as the chairperson at the Fed, and Jerome Powell's term is set to end in 2026. So there's a few options here. Option one is Trump doesn't do anything and he doesn't make any changes. He just kind of lets the Federal Reserve Bank do their thing, and then he uses them as a punching bag and says that, well, you got to blame them for not cutting interest rates. Option number two is Trump then goes out and tries to fire the chairperson at the Federal Reserve Bank, Jerome Powell, and tries to replace him with somebody who's more favorable to cutting interest rates more aggressively. Or option number three is Trump then waits for Jerome Powell to finish his term in 2026, and then he goes out and tries to replace him with somebody else who might be more favorable to cutting interest rates. And all of those things, again, would be to cut the federal funds rate, which then give your bank more ability to have more breathing room to cut your mortgage rate. So now that you understand what all the options are in trying to influence the federal funds rate, let's talk about what Trump can do in order to influence treasury yields, because that also plays an impact on what your mortgage rate actually is. Now remember, this treasury yield is the interest rate that the government pays you when you go out and lend money to the United States government. Anybody can lend money to the government. You and I could do it. Foreign countries could do it. The Federal Reserve Bank can do it. But the interest rate that the government pays you, this treasury yield, is not set by the president. It's set by market factors, which is influenced by the federal funds rate. It's influenced by inflation, and it's influenced by the economic growth. Essentially, when investors feel more confident in the economy, when they feel more confident in the dollar, treasury yields generally fall. When investors are concerned, they're concerned about the dollar, they're concerned about the economy. Well, there's more risk. When there's more risk, you want more return. That means treasury yields have to rise. So when investors are concerned about inflation or the economy, treasury yields go up. When investors are less concerned, treasury yields tend to go down, because your treasury yield is really a byproduct of risk and concern in the economy. And well, there's still a lot of uncertainty today in our economy, which makes it a little bit difficult for treasury yields to fall. For example, the Federal Reserve Bank just said that they're still concerned about inflation and they don't expect inflation to fall very easily. One of the reasons for that has to do with tariffs. You have some people that are saying that tariffs are going to be very inflationary, and then you have other people saying that tariffs are not going to be inflationary. All of that ultimately creates uncertainty, which is not good for treasury yields. But another impact on treasury yields also has to do with the economy, and there's no surprise that President Trump is very adamant on wanting to grow the economy very quickly. And if we can see more economic growth, well, that could provide some ease to help treasury yields fall. Now, why does that matter? Again, because treasury yields help out over here. When banks are comparing different investment opportunities, they're comparing you to lending money to the United States government. And if the government is paying out lower yields, then the bank has more breathing room to charge you lower mortgage rates as well. So we talked about now the federal funds rate and how Trump can influence the federal funds rate. Trump can also influence treasury yields by working to stabilize inflation, by working to stabilize the economy, although there's still a lot of uncertainty right now. But if they can get stabilized, they can lower treasury yields. That brings us to number three. And number three is what I like to call the X factor, which is a whole bunch of guesses as to what else Trump could potentially do. Let me give you an example of what I mean. Federal student loans are issued by the government, and those interest rates are set by Congress. Congress sets new student loan rates each spring based on the high yield of the last 10-year Treasury note. And some of those student loans can be subsidized by none other than the government. So what does that mean? Well, people are already borrowing money from the government to go to college, and the interest rate that people pay on their student loans is set by Congress, which is influenced by Treasury yields, but the government can also subsidize some of those student loans. So could the government potentially create government subsidized mortgages? I don't know. Yes, I already know that we have this to an extent, but maybe this is something he's considering expanding. Another part of the X factor has to do with Fannie Mae and Freddie Mac, because President Trump has talked about privatizing Fannie Mae and Freddie Mac. Now again, I don't want to get too into the details of how all these things work, but Fannie Mae and Freddie Mac are not actually loan issuers. They're not actually giving you mortgages. They're buying these mortgages from banks and then selling them off as mortgage-backed securities. And if they do get privatized, again, we don't know what the impact of that would be. Some people are saying that, well, maybe that would make mortgage rates go even higher, because then lenders wouldn't feel so confident in their ability to sell their mortgages, because right now Fannie Mae and Freddie Mac are buying every mortgage. But if they're private, maybe they're going to be a little bit more tight on which mortgages they actually buy. And so if banks have to be pickier, they might have to charge you higher mortgage rates. Other people are saying, well, maybe that could bring down mortgage rates and help mortgage rates cool even more. We don't know. So when I talk about this X factor, this could really be an anything factor, which we don't know. There are a lot of things that the president can do or potentially create as a way to potentially create new mortgages or somehow subsidize mortgages to potentially bring mortgage rates down if we cannot get the federal funds rate lower, or if we cannot bring treasury yields lower, which ultimately then begs the question, should we have lower mortgage rates? And if we do see lower mortgage rates, what would the impact of that be? Because one of the problems with the housing market today isn't just mortgage rates, it's also housing prices, where housing prices have gone up, well, a lot since 2020. Some studies will tell you that they've gone up 20 to 30%. Some neighborhoods tell you the housing prices have gone up 50%. And other places have seen housing prices go up by more than 70%. So housing prices have gone up a lot across the country. And one of the reasons for that is that, well, in 2020, 2021, and the early part of 2022, mortgage rates were very low. Sometimes 2.5%, sometimes 3%, sometimes 3.5%, which meant that you had everybody wanting to go out and borrow money, because when you can go out and get a 3% mortgage, you can go out and borrow more dollars. Because remember, if you can afford a $3,326 mortgage at 7%, that means you can only afford to borrow $500,000. But if you can borrow it at 3%, that means you can go out and borrow $800,000. So there is a risk that if mortgage rates fall too quickly, during a time when a lot of people want to buy houses, it could help housing prices shoot up even more. Now, on the flip side, lower mortgage rates could also help the supply of houses, because you have a lot of people that are sitting in homes right now that are sitting at a 3 or 4% mortgage saying, I don't want to sell, or I'm never going to sell, because if I sell my house today at a 3.5% mortgage, I'm going to have to go out and get a 7% mortgage, and I don't want to do that. So if mortgage rates were to fall, you could potentially see more people saying, now it makes sense for me to sell my house, because, well, going from a 3% mortgage to a 3.5% mortgage, not a big deal. So yes, I'm considering selling my house now. So the housing market is very complex, because there's a lot of different moving parts, and each moving part can influence one another. And so now I want to hear from you. Based off of everything that you've heard, number one, do you think President Trump will actually be able to get mortgage rates down to 3%? And two, do you think Trump should bring mortgage rates down to 3%? Let me know down in the comments. I'm looking forward to reading what you have to say. And again, if you want to stay up to date on what's happening in the financial markets when it's happening, I have the link for you to join Market Briefs down in the description. Our economy is going to change in 2025. And in this video, I want to show you how you can find the investment opportunities that most people are overlooking. Take a look. President-elect Trump is entering the White House in January, and he wants to make some sweeping changes to our government and economic policy. Let me show you why this matters. In 2024, the United States